Here's the trap almost every Vancouver buyer falls into. Your lender says you're approved for $1.2 million and your first thought is, great, let's go shopping at $1.2 million. But do you really want to be house rich and lifestyle poor? If you max out your approval, you're setting yourself up for stress, risk, and maybe even financial disaster. In this video, I'm breaking down why maxing out your mortgage pre-approval could be the single biggest mistake of your buying journey and what you can do to instead to protect your future, your lifestyle, and your peace of mind. There is a massive reason why you have a real estate advisor. It's not just to write the contracts, but it's to make sure that they have a proper overview of your budget concerns and to understand exactly where you want to be on a monthly basis and not to stretch that budget to make you uncomfortable. So we dive right in here. The first one on the list is the variable rate trap. If you are someone with a higher risk tolerance and you are wanting to be in a space with high risk, high reward, and possibly see a lower rate than fixed rates, being in a situation where you're at the maximum of lending is going to put you in a compromising position. I lived that for several years. The house that I'm in now, we had it built. It was delayed by well over a year. When it was supposed to be completed, we could have locked into a fixed rate in around that 3%, and it ballooned to almost 7% with our variable mortgage. So we were very stressed for a couple years. We had to go into savings and it was not comfortable. So that is something I do not want you to try to entertain. I know that rates are starting to drop down here a little bit. We may have another one here in September, but keep in mind, things can go up. There's so much uncertainty right now. So if you max out at the top of your pre-approval and you're in a variable mortgage, you've left yourself zero margin for any rate increases. To put it in perspective, for every 0.25%, whether it's an increase or decrease, it's about $14 per every $100,000 of lending. So if you have $1 million mortgage, for every 0.25% increase or decrease, that is $140 monthly. So it can add up very, very quickly, especially if you have an elevated mortgage. The house poor reality, when your mortgage payment balloons, suddenly you're cutting back on going out to eat, going to get drinks, children's activities, vacations, things of that nature. So you don't want to be put in a compromising position, especially right here in this market where you have a lot of selection. Be cognizant. We are still in an economic upheaval and you want to be smart with your purchase. If rates don't fall as fast as you hoped, or worse, if they climb up again, you're stuck in a financial trap that you just can't escape. Number two, the hidden cost of home ownership. A lot of buyers, when I do these consultations, they only look at the mortgage payment. They don't look at everything else that's associated to a property purchase. And that's things like property taxes, strata fees, insurance, cable, heating, whatever it may be, not to mention a buffer for future repairs. And you can see here, when the bank pre-approves you, they're only looking at your debt ratios, not your life. So it's really important to get a Google sheet out, put all these in, have a monthly budget that you can work around, and then you can start to reverse engineer to see if that property purchase makes sense. If you stretch every dollar to buy the home, where's the buffer for these real costs or unexpected repairs like a roof issue or a special assessment on a condo, and suddenly you're finding yourself stacking debt on your credit card. So instead of your mortgage rate of 4 or 5%, you're now being forced to put it on your credit card at 20-something%. And this is where things get very, very problematic. If you're in a condo, strata fees are likely going to go up year after year after year. There's going to be special assessments. If you own your own home, there's always something in terms of repairs that are needed. Or if you have a mortgage helper and your tenant damages something, you need to make sure that you have a buffer. Number three, financial flexibility. Buying a home at your maximum is going to lock you in, and you may be excited about it for the first 12 to 24 months, but over time, as the sheen and the shine of your home starts to wear off and you understand that living this life sacrificially, where you can't go out to eat, you can't hang out with friends, you can't go on vacation, you can't save for your children's future, then you start to be put in a position where you get quite frustrated. So it's very important to understand that being at your maximum isn't always the best case support. Perhaps if there's a really good value and you can get into something that you may not be able to afford otherwise, maybe it makes sense to get at your maximum, but you need to understand the consequences of it. You know, I write here, being house poor doesn't just hurt your wallet, it hurts your quality of life. What's the point of living in a beautiful home if you can't afford to live in it? and buying even $100,000 to $200,000 depending on your budget below can give you at least that buffer to safeguard yourself. Reason number 4, which is real right now, is job and economic risk. In Canada as a whole, unemployment continues to skyrocket, and we know the uncertainty that we have with the tariffs and just the global climate right now. So here's a harsh reality. Vancouver's economy is timed to global uncertainty. We've seen layoffs across multiple sectors, construction industry downturns, tech sector retrenchment, and white-collar job reductions. Right there as well, if you're moving forward, if you're carrying a maxed out mortgage and suddenly your income dips, even temporarily, you're in trouble. Lenders don't care that your industry slowed down. They want their payments. This is why so many people are now selling under stress, because they don't have any cushion. They bought at the ceiling, and when life shifted, they have no safety net. Even if you get sick, God forbid you get cancer, you get in a car accident, you can't work. If you don't have insurance on your mortgage, how are you going to be able to make that if you are maxed out? At number 5 here, I have investment and future opportunity costs. If you are in a maximum mortgage, all your resources are tied up in one asset, limiting your ability to respond to opportunities, to market fluctuations. So if you have good opportunities in the stock market, or opportunities to maybe put some money in on a build, or whatever that opportunity is, you will not have that opportunity for you. And in Vancouver, as property appreciation hasn't been that great, in many cases, saving some of that money to invest in the stock market or some other opportunities will get you a better yield right now. Strategic buffer, breathing room in your monthly budget, ability to save and invest elsewhere, and financial flexibility for opportunities. And then finally, wealth building, investment property possibilities, stock market or business investments, cash reserves for emerging opportunities are all things that are going to be wiped out if you're just at your max and you have no room for growth. When it comes to wealth, here I have a note. Real wealth is built on flexibility. If all your money is locked in one property, you're limiting your future options. And especially if you're in a space where you don't have a pension and you're not contributing to your RSP or anything else, what is it going to look like when you want to retire? Are you going to be able to retire? And is this house purchase going to preclude you from having that retirement as well? So these are all things to think about. So as we wrap up here, the smart home buyer's approach. The bank may see that you're approved for 1.2 million, but that doesn't mean that you should spend to your limit. Obviously, you get your pre-approval to know your maximum budget from lenders. Calculate your comfort zone and aim for a 10 to 20% below your maximum approval for a realistic range to fit in, and then factor in all the costs. Get that Google sheet out and make sure you're inputting everything in there to make sure that you're staying on track to maintain your financial freedom. Buying a home in Vancouver doesn't mean stretching yourself to the breaking point. The smartest buyers leave a buffer. They plan for rate hikes, hidden costs, lifestyle choices, and the unexpected turns in our economy. Real financial freedom comes from flexibility, not from maxing out your mortgage. Don't let a dream home turn into a financial nightmare. And if you have need of buying that dream home, make sure you book a discovery call. You can scan the QR code in the banner or click the link in my description. Until the next one, I'll see you later.